Hi there, welcome to Kneppy Invest. Time for a technical update. I thought today what I'm going to do is feature quite a few companies that have released either the half year or their yearly results in February, because this is my second favorite month of the year, just after August. And I thought because we have seen quite a few companies see a positive or a negative reaction from the market on the release of their financial numbers, it'd be a good time to have a look at the charts for some of those companies. So the majority of companies I'll be featuring in today's video have released their financial results already in February. Seems like most of them released those results on the 16th of February. There are two companies I'm featuring in this video that have not released their numbers, but they're interesting for other reasons. So let's have a look at the companies I'll be focusing and featuring in today's video. I think there's about 11 companies, and the first three I'll be looking at are AMP, Commonwealth Bank, which I did feature in my technical update 2 weeks ago, but we have seen the market react negatively to the release of their financial results, even though you might argue on the surface they were good results. We'll also have a look at Aurizon. And then we'll move on to a few other companies, including PWR, Advanced Cooling Technologies, one of my favorite companies on the ASX, and there was a negative reaction from the market when they released their results. Sonic Healthcare, Enero, and Aurora. And the last four companies we'll be looking at include GUD and Ridley, two companies that did release their financial results, while the last two, Reveson and KMD Brands, did not release their financial results, but their charts and the reason their charts look interesting are for different reasons. First company I want to look at is AMP, a dog stock on the ASX, if there was one. In fact, if you looked for a definition of a dog stock, AMP might be the very definition, because the share price of this company has fallen over the last 25 years. They listed, I believe, in 1998, and the share price did reach a high of $37. Current share price is $1.12. So this is the very definition of a dog stock. But at times, for short to medium term, even for the longer term, share price of AMP have gone on runs. There was a period back in 2003 to 2007 where the share price went from $4 to $11, so a three-bagger over that 4-year period. But generally, the share price has gone down through time. And I was looking at AMP a few months ago because the share price of this company had moved into an uptrend. You can just see the share price moving up from, say, the middle of last year, and the share price was in that classic developing uptrend phase with higher highs and higher lows. Although you could argue that over the past month or so, the share price, this uptrend was showing signs of weakening, because the high in the share price was back in December, and then the next high was actually lower. So a little bit more weakness in this uptrend just before the company released their results on the 16th of February. And that sort of increase in positiveness about AMP really was destroyed on this day, because the share price fell 13.4%, and this developing uptrend has been broken because of bad financial numbers from the company. Now, I have not looked at the results from AMP, so I don't intend to have a look for quite a while, if ever, simply because this, in my opinion, is not the sort of company you want to invest for the long term, which will become obvious when we look at the next chart, which is the monthly chart. So the only reason I would take a position in AMP is when the share price does go on a run. And even then, I'm going to be negative, because AMP continually disappoints the market, and it did it again when it released their results on the 16th of February, when the share price dropped 13.4%. When companies list on equity markets, public equity markets, they are supposed to create value for their shareholders. AMP does the exact opposite. They destroy their shareholder wealth, because the share price of this company has fallen from $37 at its peak back in 1998 to a current share price of $1.12. Then you might be saying, well, what about the dividends? Well, dividends probably have been falling as well. So this is the exact opposite of the sort of company you want to own for the long term. At one point in time, more than likely, AMP might have been considered a blue chip on the ASX. So the argument that investors should only invest in blue chips is broken when you consider that little fact that AMP at one point in time might have been considered a blue chip. Now, would I ever own AMP? More than likely, no, not for the long term. So no matter where the share price goes, I probably won't take a position in this company, even when the share price looks and the chart looks bullish, we have just seen on the release of their half-year results, they can still disappoint the market, and the market was wrong leading up to the release of these results. So be aware, whenever you see AMP share price go on a little bit of a run, just be wary that they can release any sort of announcement that disappoints the market, and that would be the end of any uptrend the share price is seeing. I have featured Commonwealth Bank in 2 of my videos over the past few weeks. I featured Commonwealth Bank in a technical update about 2 weeks ago, and then I did a video on whether the banks are overvalued. And my spiel during that video was that Commonwealth Bank at a P ratio of about 18, which it was last week, is expensive for this bank when you compare the P ratio to historical values you usually find for this bank. So it's not surprising to see, with the share price reaching an all-time high, that the share price has pulled back on the release of their half-year results. Now, the share price did decrease 7.6% in the 3 days after the release of their results on the 15th of February. Now, on the surface, in my opinion, the results look pretty good, but I think it's the market getting a little bit nervous about the future, particularly when you take into account the commentary from the CEO and the management of the company. So they were a bit bearish, but probably reasonable in their outlook, talking about slowing economy and slowing business credit growth. So I can totally understand why the share price has pulled back, because the market is getting a little bit more nervous about the bank's performance over the next year. Now, moving forward, I do consider Commonwealth Bank to be probably the only one of the 4 big banks that you can hold for the long term. The other 3 banks, no. But Commonwealth Bank is by far has by far the highest quality of the 4 big banks. So if, this is my long-term strategy for Commonwealth Bank, if I see the share price of this company get down to, say, below, I think it's below $70, if I see that, I might be willing to take a long-term position in this company, because then the valuation of Commonwealth Bank would be becoming attractive. And there is a bit of correlation between the United States moving into recession and a significant decrease in the bank's share price. So that could happen, and maybe this is the beginning of a significant decrease in the bank's share price. So at this point in time, I'm not willing to take a position in the Commonwealth Bank, but if I see the share price get down to that $70 level, I might be more willing, and I will pay much closer attention to the Commonwealth Bank at that point in time. Onto Aurizon, which I probably will not consider a high quality company. In fact, I have this little database where I look at companies, I look at their results, and then I just write down what I think about the company. And this is what I wrote about Aurizon. So I wrote Aurizon here, it has a mediocre growth. In fact, growth has been dropping the last few years, and I probably wouldn't expect the growth, and I'm talking about revenue growth, to be substantial over the next 5 years. So mediocre revenue growth. It has a low return on equity, so even the earnings are fairly low quality. The only thing about Aurizon, it has a nice yield. So if you are an income-focused investor, maybe Aurizon would be a company you might look at. And then the company released their half-year results on the 13th of February, on the Monday. Share price then dropped 11.7% over the next 4 days. And the reason behind that drop isn't necessarily because of the numbers. The big drop in the share price is because they lowered their dividend. So when a company that is considered an income company, so for those who are only interested in the dividends, when a company does drop their dividends, you will see a sell-off, just like you saw in Aurizon. There was a nice little bounce in the share price on the Thursday, and then the share price pulled back a little bit on the Friday. Now, I do have this horizontal line. That horizontal line is really important because it's a nice buy-in level. Now, that horizontal line is a support range. It's not one value. That'll become clearer when we look at the next slide, which is a longer-term chart of Aurizon. So around about $3.35. In fact, we'll say between $3.40 and $3.20, which is that support range. That could be a nice time to take a position in this company, because even though they have lowered their dividend, maybe it's just a one-off. So if you are an income investor, maybe now is the time to think about buying or taking a position in Aurizon, just because where the share price is right now. So let's have a look at the longer-term chart for Aurizon, and hopefully it'll become clearer why I consider where the share price is right now to be a support level or range. So this is Aurizon's, I think it's a weekly chart going back to 2015. And you can just see the share price going sideways. Lots of volatility in the share price. But typically in high quality companies, you'll see the share price go from the bottom left to the top right. And that usually matches increase over time of revenue, earnings per share, and that sort of thing. Aurizon is not a growing company. The only thing it has going for it is a nice dividend yield. But 3 times, in fact, this makes it the 4th, but 3 times in the past, we have seen the share price get to this level or this range and then go for a nice little bounce. First time was back in 2016, then during the COVID-19 financial panic, and then towards the end of 2021. The only concerning thing is 2 of those or 3 of those times it's got down to this level have been in the last 2 years. And as you can see, the share price went to a high of $6.10 back in 2019, has fallen ever since then. So there is a possibility that even though I would consider that range between $3.20 and $3.40 to be a good support level, there is potential that that support level will be broken. And there is also a possibility that the catalyst behind this support level being broken is this drop in dividend. If the drop in dividend is permanent, that would be horrible news for Aurizon and for its shareholders. Now come onto a company that I do like. I've held PWR on occasion. I bought into this company on a breakout back in February 2021, and this particular chart goes all the way back to November 2020. And this is a classic example of watching for a breakout out of a trading range and how the share price can increase by 100% in 1 year when that breakout is on the back of a really good financial report. So when this company released their half-year numbers in February 2021, the share price increased a lot and the share price kept on going up during 2021. In fact, the share price went from about $5 to a high of about $10.25 in less than 1 year. And since then, you can see a lot of volatility in the share price. Share price went almost back down to $5 in June of last year, but the share price then more than doubled in the second half of 2022. And the share price did reach an all-time high a few days before the company released their half-year results late on the 16th of February. Now, when I say late on the 16th of February, they released their results after trading had closed on the Thursday, which is never a good sign. Now, that's a generalization, but whenever I see a company release some news after trading has finished for the day, it's usually not good news unless it's suddenly come upon the company and they have to release it after trading had closed. And this was not good news. That's what the market says, because the share price fell 13.8%. So the market didn't like it. Now, I have a different opinion from the market, which is okay. You can have a different opinion. Typically, the market is right, but the reason I have a different opinion from the market, and also the reason I took a position in PWR when the share price fell 13.8% is because I don't think the reason why the market panicked and sold off on PWR is a long-lasting thing. So there was a drop in margins, which led to a slower growth in profit and that sort of thing. But revenue was 16% higher. And when you, I don't think it was in commentary, it was in the, so the CEO did a little bit of a talk, whatever you call that, I forget what you call it. And they actually mentioned, or someone mentioned, that they do expect margins to increase in the second half of the year. So even though margins were down, I do expect a rebound in the margins based off what the management says. And that means I think the second half is going to be significantly better for PWR. Not only that, I expect significant growth in this company over the next 10 years. So this is the very definition of a growth company. In fact, this particular chart is the very definition of a chart you want to see for a higher quality company, with the share price going from the bottom left to the top right. Doesn't move in a straight line, as you can see from this chart. And whenever you see in high quality companies share price pull back like PWR did in June, I'm just kicking myself, I didn't buy into PWR back in June. That's the time to buy. That's the time to take a position when the share price pulls back and there's more attractiveness to the value. So at this point in time, I did take a position in this company because the share price fell 13.8% on the release of their half-year results. And I do think on this occasion, the market is overreacting. Now, I could be wrong. And if I see the share price pull back even further, I will add to my position in this company. So then my next, say, buying price for PWR would be around about $6 to $6.50. If I see the share price gets down to that level, and there's a possibility it does, particularly if we see further weakness in the markets, I think there's a little bit too much optimism out there. And if I see PWR share price get down to, say, $6, $6.50, I will add to my position. The next company I want to look at is not called Kathmandu anymore. It is called KMD Brands. I totally forget this, but I always think of this company as Kathmandu. And I think they changed the name because they bought Rip Curl a few years ago, and really because possibly Rip Curl might have more sales than Kathmandu. So it wasn't really representative to be called Kathmandu anymore, because this is a more diverse company. Hence the change of name to KMD Brands. But the share price had fallen a lot in 2022. In fact, the share price went from $1.60 all the way down to a low of 85 cents. You can see that well-defined downtrend during 2022. But the share price was going sideways and then showing signs of breaking out. And the company did not release their financial numbers in February, but the company did release a trading update on the 14th of February, and the market responded positively to that trading update with the share price up 8%. The only word I've got here is bullish. So there was a little bit of bullish commentary within the commentary of this trading update, and that's why the market has responded nice. And not only that, the share price at the end of the week was or closed just above a resistance level at $1.03. So share price closed at $1.04.5. So this could be the breakout for KMD Brands. And if the share price gets above $1.05, that would mean the share price is at least a 6-month high. But I'm a little bit wary about retail companies right now because of a lot of headwinds moving forward for these companies. And even though KMD Brands has benefited from traveling opening up, because the only time I've gone into a Kathmandu store was when I was going overseas, say going from our summer to the European winter, and I needed some warm clothing. And I decided to go to Kathmandu, buy some warm clothing. That's the only time I've gone into Kathmandu. So it seems like Kathmandu, maybe even Rip Curl, has really benefited from traveling opening up. More travelers coming to Australia, that sort of thing. More Australians going overseas. So that's why the share price, I think, has rebounded, why they're a little bit more bullish. But I can also envisage a future where sales or revenue drops because of a slowdown in the economy, slowdown in retail. So that's one little worry thing I have against KMD Brands right now. By far, the biggest negative reaction I did see during the week when a company released their half-year or full-year results was for the company called Innero. Share price dropped 22.6% in the one day. Now, on first glance, the results look pretty good. EBITDA and revenue up 39%. So nice growth in the company. Maybe some of that revenue and EBITDA growth might have been because of some acquisitions. I have to have a closer look of the results. But in my opinion, it's not really the results itself that caused this negative reaction from the market. It was the trading update the company included within the results. And some of the commentary and some of the words the company used is why the market reacted like it did. So just listen to some of these words in the commentary. Headwinds, lower growth rates, slow start to the calendar year, slower client decision making. So the market is expecting Enero to really suffer during 2023 based off the commentary from management. So the market is possibly even expecting a significant decrease in profit, decrease in revenue, that sort of thing. So if the market is wrong about this, and maybe the management is going to be wrong, this company is looking awfully cheap right now. But there's no reason to think the market and the management are going to be wrong. I do think there's going to be a lot of struggling for many companies in Australia over the next year because of this slowdown in the economy, and possibly Enero is one of those. But if the market and the management is wrong, this company is looking awfully cheap at this point in time. But I'm not willing to take a position just because the market might be wrong. It might also be right, and that's the reason why the share price reacted the way it did. That's the reason why the market sold off on this company, and that's the reason the share price dropped 22.6%. From the ugly that was Enero to the good that is Aurora. Share price has rallied quite a bit, 18%, on the release of their half-year results on the 16th of February. And this is an instance where the market got it wrong. You can see the share price in a downtrend, a nice developed downtrend. In fact, the share price dropped from $4 back in April of last year down to a low of $2.85 just before they released the half-year results on the 16th of February. And then the market was surprised. The results were better than expected. And that's very important to note, that it's not about the results itself. It's about how different the results are to expectations from the market. So revenue up 14%, profit up 8%, and the market did not expect that. And that's why the share price rallied 18%. So a really interesting reaction from the market. And the chart looks really interesting now because this downtrend has been broken. From the ugly that was Enero, to the good that was Aurora, to the absolute impressive that was GUD. And the market absolutely loved the half-year results from GUD that they released on the 15th of February. And not only did the market react on that day, that positiveness from the market continued into the next 2 trading days. So over those 3 trading days, the share price of GUD rose 22%. Not only that, this was a breakout in the share price. Last time the share price was this high was back in June last year, when the share price of this company fell from about $12 to $7. And the share price has risen from about $8.20 to a current share price of $10.04. So a very positive reaction from the market. In fact, when I had a glance-through look at the results, I was taken aback. I went, ooh, these numbers on first glance look really impressive. Revenue up 56%, earnings per share up 56%. Now, the company did make an acquisition that might have had a positive effect on the results, but usually the market knows that. Usually the market doesn't respond this well when there's any of those sort of questions about the results. So I think the market might be just digesting these numbers, and as it digests these numbers and more, say, fund managers realize maybe these numbers are real, that's why we have seen a positive increase in share price over 3 trading days. A lot of times you'll see an initial reaction from the market, share price up on the day they release the results, and then share price goes sideways. I usually say that's a fairly bullish sign, but when you see the share price rise over 3 consecutive days, that's an ultra bullish sign that maybe there's something in these results. So I'm going to have a closer look at GUD results and just try to understand why revenue is up 56%, why earnings per share is up 56%. Is it just because of the acquisition, or is there just something more to this company right now? Revasum did not release financial results, but this is a really interesting, intriguing situation going or unfolding for Revasum right now, because we have seen a rapid rise in the share price in a very short period of time on the massive volume. I'll talk about the volume in a second. But the share price rose 45.5% on Thursday, the 16th of February, and then 25% on Friday, the 17th of February, on no specific news. The company did release a price and volume query from the ASX because they wanted to understand why the share price was rising so rapidly on really high volume. But if we go back to the 8th of February, the company released an announcement called or titled SQN Financing Facility Update. And since then, the share price has risen from 14 cents to 30 cents. And we also seen a massive rise in volume. And I think that announcement on the 8th of February might have alleviated some concerns from the market about the viability of this company moving forward, because Revasum did not meet some of the financial covenants in their facility or their financing facility. And this announcement alleviated some of those concerns because they have a new financing facility. The other thing to mention here is that massive volume. So we have seen 1.5 to 3 million shares traded over the past few days. And before this announcement on the 8th of February, Reveson was lucky to see 100,000 shares traded in a day. So there is some reason why there's this massive volume suddenly coming in for Reveson and why the share price is rising so rapidly. It's really hard to understand and to envisage that this SQN financing facility update on the 8th of February is a reason behind this sudden increase in attention being paid to Reveson. Maybe it is. Maybe it is simple as that. If I told you the revenue for a company was down 14%, profit and earnings per share for a company was down 54% to the previous corresponding period. What do you think the market reaction would be? Would you expect the share price to be down 50%, 30%, 20%, or up 14.3%? Well, in this instance, you'll be wrong if you said anything other than up 14.3%. Yes, Sonic Healthcare released really negative numbers, decrease in revenue, 54% decrease in profit and earnings per share, yet the share price increased 14.3%. And the reason behind that increase in share price is because the market was expecting worse numbers. The market was expecting revenue to be down worse or more and profit and earnings per share to be down more than 54%. So in this instance, it's not about the numbers itself. It's about the numbers beating market expectations. Now, there's another reason why the share price might have rallied by 14.3%, and that is because of a bullish outlook from management. Now, I have not had a look at Sonic Healthcare's results just yet, but those are two reasons why the market might react positively when on first glance the numbers look absolutely horrible. So just don't look at the numbers itself. Also try to understand expectations. Also try to have a look at the outlook. If you don't know the market expectations, just look at the market reaction. And if the share price is up 14.3%, there's something the market likes. And you can just see by the Sonic Healthcare share price in the chart. Share price was in a well-defined downtrend with lower highs and lower lows. And the most recent low was 2 days before the company released the half-year results. So the market was not expecting good news from Sonic Healthcare, and the share price has increased from $28 at that low to a current share price of $33.45. Now, I'm not confirming that this is the end to the downtrend to Sonic Healthcare because the share price was in a nice downtrend and there's a lot of resistance moving forward for this company. But if I see the share price go sideways over the next few trading days, that would be a bullish sign. What we don't want to see moving forward is a really good sell-off with high selling volume like we have seen with MoneyMe. Have a look at MoneyMe's chart, which I'm not showing in this particular video. They had a nice rise in share price maybe 2 weeks ago, and every day since that rise in share price has been dripping lower and lower on pretty good selling volume. So that is telling us that the reason behind that really big update for MoneyMe was there was no strength to it. So what we want to see is some strength when a share price rises like this for Sonic Healthcare. We want to see no selling volume, no big down days. We preferably would like to see the share price go sideways, or maybe even the share price to go higher from here. So paying close attention to Sonic Healthcare because possibly there is some good value right now because the market was expecting worse results than Sonic Healthcare gave us. The last company I want to look at is Ridley Corporation. I don't know much about this company at all. And just by looking at this chart, which is a daily chart going back to the end of 2021, this is a nice looking chart. Share price in a nice uptrend. Share price had been going sideways for the past about 5 months or so. But then the company did release their half-year results on the 16th of February, and the share price rose 12.5%. on that day. So again, another company whose results beat the market expectations. But you can see the share price, if you look closely at the chart, finished around about $2.20. If we go back to the period between about September and November last year, share price for really struggled to get above $2.20, $2.25. So this little level between that $2.20, $2.25 is a resistance level. If we see the share price of really get above $2.25, that would be a bullish move. So I've put Ridley Corporation onto my watch list. I'm going to do a little bit of research on this company. In fact, I might do a standalone video on this company simply because I have not looked at Ridley Corporation at all in the past. That's all I have for this technical update, focusing or mostly focusing on companies that have released the half-year results or full-year results in February. Also looked at KMD Brands, whatever it's called, and also Reveson, probably one of the most intriguing situations going on the ASX right now. Don't fully understand why the market is reacting so positively to that company. Anyway, if you have any questions about any company I featured in today's video, I'd love to hear your thoughts, so leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.